Hi friends, today we are going to discuss about the difference between covered interest parity and uncovered interest parity. So let us look at it what it is with some example. So CIP holds the interest rate differential between two currencies in the cash money markets should equal the differential between the forward and spot exchange rates. So it involves using forward contracts to cover exchange rate, whereas uncovered interest policy doesn't. So let us look at with some example. For example, you are investing let's say 100 rupees in India for 1 year. So you will earn some interest for 1 year. Let's say you are earning about 5% interest rate. So this is what you will get at the end of the year if you invest in India. Let's say this is X amount. For example, now you are investing this amount in US. So before investing, what you should do is you need to convert this 100 into USD. So you have INR 100 and you are converting into USD based on the exchange rate. So based on today's exchange rate, you have converted this amount into USD and then you have invested in US for 1 year and you will get interest, let's say about 2% of interest. And then you need to convert this amount back to INR to get into Indian currency. So again you have exchange rate involved in this. So let's say after that exchange rate you will get amount of Y. So now there is a risk of exchange rate after 1 year because you are not sure how much you are going to get after 1 year. So what covered interest parity concept says is that the X should be equal to Y. So how it happens is that the covered interest rate arbitrage, which is an investment strategy used here, and it is designed to profit from the differences in interest rates between two countries. So when buying and selling foreign currencies. So it involves using a forward contract to limit exposure to exchange rate risk. So covered interest rate parity says both X and Y should be equal. So we call this covered interest rate parity because we have eliminated the exchange risk with the forward rate contract to cover the exchange rate risk. So this is how CIP is covered. So but if you talk about UIP, which is uncovered interest parity, so in this case the difference is that the future exchange rate is replaced with the expected exchange rate. So here there is no such risk coverage and you are going to calculate with the actual exchange rate after 1 year. Hence this is what call about uncovered interest parity. So this is all about CIP and UIP. Thanks for watching. Like, share and subscribe and press bell icon if you want to watch my latest videos. Thank you.